Good morning, good afternoon, good evening. Let's start with our next important topic, that is IRA. What are the qualified contribution, distributions, deductible contributions, taxable distributions? What are the exceptions to the early withdrawal penalty? Everything is covered in this particular topic. So when you have a retirement account, it can be categorized specifically two main category. One is traditional IRA, second is Roth IRA. Please remember one thing, whenever you are going to contribute into traditional IRA, all the contributions will be deductible. For Roth IRA, all the contributions will not be deductible. The maximum limit which you can contribute in both the accounts, either in traditional or Roth or in both the accounts, in total you can contribute maximum $6,500 or whatever is your earned income. Please remember this thing, that every earned income is only eligible for the contribution limit. So $6,500 or whatever is your earned income. Earned income means where you are actively involved, or there is a catch-up contribution of $1,000, means if your age is more than 50 or is equals to 50, you can extra contribute $1,000. So it will be $7,500 in case of age limit is more than 50. Okay, so there is no phase out limit in case of contributing this amount, but for Roth IRA there is a phase out limit. So when you contribute this balance amount, let's say 6,500 or 4,000, 2,000, maximum how much you can contribute, there is a phase out in case of Roth IRA. There is no phase out in the traditional IRA. So how the phase out will apply depending on the filing status. Let's say you are going to file a unmarried. As an unmarried, then the phase out limit will be between 138,000 to 153,000. I hope everyone know how to calculate the phase out exclusion, right? We have done it in the regular class. MFJ filing status, you will be having a phase out limit of 218,000 to 228,000, and for married filing married filing separately, it should be here. It should be 0 to 10,000. Okay, what are the consequences if you are going to contribute more than the amount which is specified above? The consequences is you will have to pay a excise tax of 6% along with filing a form number 5329. Okay, but let's say you want to save yourself from the penalties, so you have an option. Okay, you can take the extra contribution as a withdrawal. Okay, you can withdraw the amount from your Roth or from traditional, wherever you have contributed extra as compared to the above limits. Okay, so see, in case of excess amount which you have contributed, if you're taking the distribution only for that excess amount, and if it's a traditional IRA, no tax will apply. Only extra amount you are taking as a distribution. Same way, if you are going to take a Roth IRA, contribution is done in excess. Now you are taking the distribution only for that excess amount, nothing is taxable. Now let's see, if you are distributing more than the extra contribution, let's say let's take an example. You have contributed $7,000. Your limit for contribution was $6,500. So extra $500 which you have contributed, you can withdraw it without any penalty, without any tax. Okay, but instead of withdrawing 500, you straight away withdraw $1,000. So extra 500 which you withdraw will be liable for penalty, that is early withdrawal penalty. Also it will be liable for the taxes. If it's a traditional IRA, you will include it in the income plus 10% early withdrawal penalty will apply. Okay, same way for the Roth, there won't be any tax because anyways the Roth contributions were non-deductible. So when you are going to take a distribution, it will be non-taxable. Got it, guys? So this is about the whole situation is about the making the contribution. Now out of this contribution, how much will be deductible? Let's look at the next page. One is Roth IRA, where nothing is allowed as a deduction. So no need to look at any conditions or anything. Whatever you contribute in the Roth, no benefit you will get at the time of making the contribution. But for traditional IRA, you can get a benefit of all the contribution. Let's say you have contributed 6,500. There is no limit in contribution, right, for traditional IRA except for 6,500 and 7,500. So whatever you are going to contribute into the traditional IRA, the whole amount is allowed as a deduction except for two scenarios. Okay, what are these two scenarios? Let's say if a taxpayer is covered by retirement plan. Okay, if a taxpayer is a working professional, he might be covered by the retirement plan at a workplace. Let's say his employer has taken a retirement plan for him, right? So if a taxpayer is covered by the retirement plan at the workplace, then in that case the deductible portion will get limited. The deductions will be applicable based on the AGI phase out limit. The AGI phase out are for single or HOH 73 to 83, for MFJ or qualifying surviving spouse it will be 116 to 136, and for MFS it will be 0 to 10,000. Okay, but if a taxpayer is not covered at the retirement plan, then and also spouse is not covered. If the taxpayer is not covered, even the spouse is also not covered, then there is no limit. Straight away you can take the whole deduction, 6,500, 7,500, whatever you are making the contribution, you can take the whole deduction. But if you are a single, HOH or qualifying surviving spouse, even then there is no limit. Only the limit is in these two scenarios if you're filing as a married filing joint return. The taxpayer is not covered. See, taxpayer is not covered, but spouse is covered by retirement plan. So cumulatively, how much deduction they can get on their 1040 return as an adjustment to income for IRA contribution, it will depend on the phase out limit 218 to 228. Okay, same way if they both are going to file a separate return, taxpayer is not covered but his spouse is covered, even though they are filing a separate return, there will be a phase out of 0 to 10,000. Okay, so please understand, there might be some MCQs from wherever you are practicing the MCQs. There might be many MCQs based on these two scenarios, and these two scenarios needs to be understood logically. Okay, don't try to mug up the limits. Understand this thing, if anyone is going to be covered at their workplace, then their AGI limit will be different as compared to those who are not covered by the IRA plan at the workplace. So please don't get confused, and remember the limits. These are the deductible contribution. See, these limits are for making the contribution. Once you make the contribution, how much is deductible, you will know to the know based on the second chart. Okay. Next one is qualified charitable distribution. If you want, you can make a deduction on like you can put aside some amount for the charitable distribution, and that will be considered as a non-taxable. But only and only this is applicable for traditional and Roth, plus the taxpayer should be at least 70.5 years of age. Okay, and when it will be non-taxable, if the amount from the IRA account is distributed directly by the trustee of the IRA. Trustee means who's handling the account, okay, who is managing the account. Trustee of the IRA to the organization who is eligible for tax deductible contribution. Okay, exempt organization who are listed, who are qualified organizations, charitable organization, directly the payment should be made by the trustee of the account directly to the organization. No middleman, no middle person should be involved in that. Now maximum how much you can contribute is 100,000 if a single person is there. If you're filing a MFJ, you can contribute 200,000. Okay, and it will be reduced by the deductible contribution for all taxable year after the taxpayer attains the age of 70.5. So as soon as the person attains the age of 70.5, any contribution which he has taken, any IRA balance which he has withdrawn, any distributions which he has taken, you need to accumulate that. And now let's say at the end of 74 years, you are going to do a qualified charitable distribution from your IRA account. Your limit is 200,000. Assuming that the taxpayer is a married filing joint return. Out of that, all the previous distributions which a person might have taken will be reduced. Clear, guys? So this might not come that, not that much important. This might not come in exam, but be aware about each and every scenarios, concepts and everything, because if you learn more logically and with more interest, then you will enjoy solving the MCQs, okay, instead of just doing for the sake of clearing the exam, right? So see, this one is clear, deductible contribution. One of the option is you can put aside for the charity after the age of 70.5. Now next is, when you take a distribution, what will be the scenario? As and when you are going to take a distribution, it will always be considered as a taxable, okay, in case of traditional IRA. In case of traditional IRA, it will be considered as a taxable. Why? Because when you took a, when you're going to make a contribution, you took a deduction at that time, right? So now when you're taking out the money from this distribution, you are going to make it taxable, right? In case of Roth IRA, it's a vice versa. When you make a contribution, there was nothing allowed as a deduction on your adjustment to income. But now when you're going to take the when you're going to take the distribution, it will be considered as a non-taxable. Got it, guys? So what is the age limit after which you have to compulsorily take the required minimum distribution? Let's say you didn't withdraw anything from the IRA account. After reaching the age of 73 years of age, you need to take a RMD. No need to remember any RMD limits or anything, because RMD is required minimum distribution limits are based on the life expectancy. Case wise, it will be different amount. Okay, so if no required minimum distribution you are taking, there will be a 50% excise tax. You have to pay the 50% of excise tax. Along with that, you have to file the form 5329. Right now, let's see if you're taking a early distribution. Either it's a Roth IRA or either it's a traditional IRA. In any of the scenario, if you're going to take a early distribution, it simply means that you are withdrawing the money before the certain age limit, and IRS has given the age limit, that is 59.5. Okay, usually people will deposit the money in the IRA account from their earned income. Okay, till the time they are earning, they'll deposit it. And when they will withdraw it, when they require those money, when they don't have the proper earnings. So at the age of 59.5, after that, you can be allowed to withdraw the money. But before this age, if you start withdrawing the money, you will be liable for the additional early withdrawal penalty, that is straight away 10%. Okay, this limit is applicable, 59.5 years age is applicable for all the 4 types of accounts: traditional, Roth, SEP and simple. SEP is a self-employed pension plan. Being a self-employed, okay, you have taken a retirement plan for yourself, for your employees. Simple plan is a savings incentive match plan, means employer and employee will fix a particular amount and they will contribute that much percentage into the IRA balance. Okay, a particular percentage of their earnings they will fix. Let's say employee is going to contribute 2%, so employer will also contribute 2%. Employee is contributing 1%, employer will also contribute 1%. So that is a match plan. Employer will be matching the employee's percentage of deposit into the IRA account. Got it, guys? So see, just remember one thing: in case of simple IRA, if it is withdrawn, I'm talking about this match plan, okay, if it is withdrawn within 2 years from the date of participation, then straight away the penalty will be 25%. Please remember, guys, in IRA topic, penalties, age limit, the exception to the penalties, this all are important. I'm not going to mark a single topic, but I'm just want to give you an overview, the whole IRA topic from each and every angle, including the age limit, the this phase out limit also, if you can remember, that's good, because recently in recent exam one of the students gave the feedback that the phase out limit was not given in for checking the traditional IRA deduction. Okay, and taxpayer was covered by the retirement plan. So make sure to remember all the phase out limits. In distribution, what are the age limits, and here 73 years is the required minimum distribution age limit. So please remember this. Okay, now let's see, usually 10% will apply if you're going to withdraw it before 59.5. But IRS is liberal upon certain circumstances, that if you are withdrawing it for this many reasons, we will not charge you penalty. Please remember what we are studying, the penalty exception. This is not a non-taxability. It will anyways be taxable. See, if you withdraw something from traditional IRA, it will anyways be taxable. If you withdraw something from Roth IRA, then it won't be taxable. But the thing is, before the age limit or after the age limit, if you are withdrawing, then the extra penalty, applicability, non-applicability will come into picture. So this is the types of scenarios where 10% penalty is not applicable. Let's read it one by one. So I have bifurcated here amongst different plans. First one is for qualified and for IRA, means this first scenario is applicable for all type of plan except for Roth. Okay, for all type of plan this will apply, means traditional IRA, SEP and simple. Qualified means SEP and simple, IRA is traditional IRA, and for Roth I have mentioned it separately. Okay, qualified plan only for SEP and simple we will using the second table. Okay, third table is for IRA only, means only for traditional and only for traditional IRA, the third table will apply. Okay, I'll just mention here quickly. This is for SCP, this is for simple, this is for this is for traditional. Okay, and this is only and only for simple and SCP. Okay, and this is only and only for traditional. So what I have done is a very simple thing. This all conditions were given in a lot of theoretical format in the publications. Okay, so we have to remember the criteria for each and every type of retirement plan. Okay, so that is the reason why for all retirement plan, this all conditions will apply. But extra conditions will also apply for SCP and simple and for traditional separately. And the last one here you can see is only for Roth IRA. Okay, so let's see one by one. First one is if the distributions are made to the beneficiary at the time of death. The taxpayer died and the beneficiary is going to receive the distributions. Okay, so 59.5 years of age, before that the person died. If it is a SCP plan, simple plan, traditional plan, at that time if you are going to receive the distributions, it is not liable for penalty. Second one is if a taxpayer is totally and permanently disabled. Okay, in case of disability. So first one is in case of death, second one is in case of disability. Okay, third one is distribution made as a part of taxpayer's life expectancy by way of periodic payment. He starts receiving the pension payments. Okay, also he is separated from the employed, he is retiring from the job, plus he started receiving the payment from the retirement account. Okay, this can be applicable for simple and SCP plan mainly. Next one is distribution applied for medical expense. If you are using this withdrawal amount for medical expense, that medical expense should be not, like the withdrawal amount should not be more than 7.5% of AGI minus medical expense. Like whatever is your medical expense, actual medical expense, this is exactly the limit of itemized deduction, which we will see in the upcoming chapter of deductions. Okay, so medical expense minus 7.5% of AGI. If this much amount is up to the distributions, like you can take a distribution only up to this much amount from the IRA, not more than that. This is what you can remember. Due to the IRS levy of plan, okay, there is a levy or seizure of the assets because of non-payment of taxes, non-payment of interest, penalties, huge penalties, interest, then IRS can levy all your asset. One of the asset is retirement plan account. Okay, the balance if they are levying and they are going to withdraw the amount for their own benefits, they are like for recovering the tax, that is not a taxable distribution. Okay, then we have as a qualified military reservist distribution. So all the military people who keep a fund, okay, a fund is created where they are contributing a certain amount voluntarily, and now from that reserve you are taking distribution. That doesn't mean it's a IRA distribution, it is not liable for the 10% additional penalty. Okay, last second one is relating to the certain federal emergencies. Okay, let's say due to some federal disasters, there is a loss of property or anything, and you want to withdraw the amount to recover that loss. So up to $100,000 you can easily withdraw without any penalty. Distributions up to 5,000 if a qualified birth or a adoption distribution. Okay, so let's say if a taxpayer and the spouse are planning for a qualified birth, for a children's birth, or for adopting a child, they each can withdraw 5,000. The condition is the child whom you are adopting should be less than 18 years. Each parent can get a 5,000 for each child. Now this you can withdraw 1 year before the adoption or birth and 1 year after. So within the 1 year from the date of birth or adoption, you should withdraw this amount, and that will be not liable for the 10% penalty. Okay, now let's see, next one is qualified plan only. Only qualified means simple and SCP plan you are going to check. If you are going to withdraw something from this two plan and it is the age of the taxpayer is less than 59.5, then you need to check that at least the person should be 55 years of age, plus the taxpayer is separated from the services. So these two conditions need to be checked together. The person should be at least 55 plus a person has retired from the services. Second is the distribution made from a qualified government plan. Okay, so he should be working as a government employee. So from that qualified retirement plan which is designed for the government employees, plus he is a public safety employee. What is public safety? Let's say police department is there, fire safety is there, some government hospitals are there. So those are working for the public safety. So those are public safety employees, and for them there is a government retirement plan 403B, 403C. So those are the retirement plan which are applicable for government employees. If they want to withdraw something from that account, they should have at least reached the age of 50 years. Then penalty of 10% will not apply. Okay, then we have is a qualified domestic relation order. Under qualified domestic, QDRO means qualified domestic relation orders. If a nominee is going to receive a payment under the name of alternate pay. QDRO means the person, two person are living together, they are not married, okay, but since they are living under same roof, let's say that other person is been added as a nominee in the IRA account. Okay, live-in relations we can say. So that is a qualified domestic relation order. Under this, if they are going to receive a IRA distribution for their beneficiaries, okay, then it is not liable for the 10% penalty. Next is distribution of a dividend from employee stock option ownership plan. Okay, so you are going to have a distribution of a dividend from employee stock ownership plan. Then in that case, it is not liable for the penalty. Okay, next one is corrective distribution of the excess contribution. Corrective distribution means what? In earlier we have seen, if you have done an extra contribution, you are just withdrawing that extra 500, then it is non-taxable, not liable for the penalty. I am not saying non-taxable, it will not be liable for the penalty. Okay, don't misunderstood the word between penalty and taxability. These are just the exception for early withdrawal penalty, and this is the most important topic. They can ask you indirectly from any of the situation, any of the scenarios. So be prepared for all the criterias and scenarios very well. Okay, now if you are going to withdraw from a traditional account, see, this all benefits are anyways allowed for all type of IRA, but for traditional we have some additional benefits. One is, if you're buying the home for the first time and up to $10,000 you are withdrawing for buying the home, okay, and this $10,000 is applicable for each spouse, taxpayer, spouse, both it will be applicable. Okay, distributions for a qualified higher education. Okay, qualified higher education, if you're going to pursue some higher education, you can take the contribution from this IRA account without penalty. There is no limit on it. Okay, the third one is, if you're going to pay a health insurance premium while you are unemployed. If a taxpayer or spouse is unemployed and they are not able to pay their health insurance premium, but they have a lot of balance in IRA account, so they will start withdrawing from the IRA account at the time when they are unemployed. They will pay the insurance premium from that account. Okay, last one is returned IRA. That is nothing but your excess withdrawal which you have done, excess contribution which you have done, you are just withdrawing that, right? So last one is for Roth IRA. Now let's say you are contributing into the Roth IRA. There is no restrictions on contribution except those for phase out limits. Okay, you have contributed enough money within the limit and everything. Now you want to take a distribution. What a normal people will think, when you're taking a distribution, it is anyways non-taxable. So let's take the distribution at any point of time. The answer is, for taking the distribution there is a specified age limit, and for Roth IRA, please remember, at least 5 years you cannot make any distribution from the Roth IRA. So based on this, there can be one MCQ that, like, they'll give you a case scenario. Just need to remember on what date you initially contributed to IRA, Roth IRA. From that date till 5 years, you cannot make any distributions. Now, let's say if you want to make a distribution, your age should be at least 59.5. Okay, but your age is not 59.5. You should take a distribution only after 5 years, or you are just taking a distribution to buy a new home, or for education, or for the health insurance payment purpose while you are unemployed, or you are just withdrawing the excess contribution. Okay, so these are the 4 conditions. In Roth IRA, probably there are very simple and small conditions are there. Please remember, because there can be some of the questions from the Roth IRA. Okay, so that's it for the IRA account. Now let's see, when you take a distribution, and there is a distribution due to death. So if a spouse is going to take a distribution, surviving spouse will able to take the whole account and roll it in her own name. So that is rolling it forward in the name of spouse. So at the time of death, usually if any other beneficiary is going to receive the IRA account, then it is mandatory that he should withdraw the whole balance within 10 years. And as and when he start withdrawing, it will be taxable for him. Okay, so that's why they have made it mandatory. As soon as the person dies and the balance is being transferred, or the balance is being given to the beneficiary, it is his duty to withdraw it within 10 years. Right? So in what manners, what are the methods to take the distribution? Lump sum or a life expectancy. He can ask them to provide some pension plans. Okay, like this annuity, just like annuity in pension, you are going to do a lump sum contribution. So take out the whole money from the traditional and do a lump sum contribution to an annuity pension plan and start receiving monthly installment amounts in the form of pension plans. Okay, so one is lump sum, you can withdraw it. Second is you can receive the income through life expectancy in every month a little bit amount. And the third one is 5-year deferral. Next 5 years you can defer it and then start the withdrawal. Okay, for spouse it's very easy, no need to withdraw it. If she wants, she can withdraw, else they can just convert it into their own name. That's it. Exception for 10 years. Okay, who are not eligible for 10 years? See, spouse can withdraw at any time. There is no compulsion that he or she, whoever is the surviving spouse, should withdraw it within 10 years only. Second is, if a child is going to be the account owner and he is not reached at the age of majority, then he will get the excess only and only after the 18 years after attaining the majority. Third one is, if a person is disabled or chronologically ill person, for them that much number of years are removed, and then the 10 years time limit for withdrawing amount will be excluded. Next is a person not more than 10 years younger. So let's say the taxpayer and the person who is the beneficiary, the difference between this two age is not more than 10 years, then they will have the option to exclude certain number of years. Means there is an exception to this 10 years in the scenarios. Okay, so please remember this IRA from all angles. I have covered the IRA. Later in the upcoming chapters, there will be anything which is relating to the retirement plan or the traditional or Roth IRA. I'll just explain you at that time. Okay, so let's continue. Next is annuities. What is annuities? You have to just put a lump sum amount into the one balance, into one fund, into an account, and you can agree to take a distribution after a certain age, or even if you want, you can start taking the distribution right from the next month of the date of contribution. Okay, so the phase where you are accumulating the balances, either you can put a lump sum, or from your earning income you can put a little bit, certain percentage of your earning into the annuities. Okay, so it's a converting an annuity into the series of periodic payment. Converting the whole lump sum amount, you just have to give the whole amount and then it will be converted into series of periodic payment. Right? So one is accumulation phase and second is distribution phase, means when you start receiving the annuity. What are the exchanges? During the accumulation phase, a policy holder may exchange an annuity under section 1031 of the policy with another provider without recognizing of the tax. Let's say there is a one of the company who is providing the annuity business, so company A. Now if I want to change my this company, right? If I want to change it, I can easily change the company to some other company without paying any taxes. So this is called as exchange. Okay, exchanging our company during accumulation phase only. I'm not talking about distribution phase. So during the accumulation phase, a policy holder may exchange an annuity. Okay, I can exchange the annuity to policy with another provider. Provider means who is providing the policy services, right? So this is what all about the annuity. Here is one example. Let's say Mr. X spends $100,000 for immediate annuity. The insurance company will pay Mr. X how much? 500 for each month for next 20 years. So 500 for each month for 20 years. Can I say 240 month? Total 240 month is going to receive $500. So let's see what is the cost which he incurred. So $100,000 divided by 240, his tax-free portion out of this 500, the cost of this annuity is 416.67 and remaining amount will be liable to tax. Remaining is a taxable. Okay, clear guys? Now let's see what are the prohibited transactions between the plan and the taxpayer. See, the plan means retirement plan, annuity plan, whoever is a fiduciary trustee who is taking care of the day-to-day operations, who is taking the contribution into the account, allowing the distributions and all, that person is called as a plan fiduciary. Okay, so the who act as a fiduciary, he cannot deal with the plan asset. Here plan asset means the retirement plan account, annuity account. Okay, for his own interest he cannot use that money. Second is the taxpayer or the fiduciary or use of the plan asset or income for the benefit of a disqualified person. Who will be the disqualified person? Anyone related to the fiduciary will be disqualified person. You can read the definition over here. It's a detailed definition given. But just remember, anyone who is related directly, indirectly to the fiduciary will be considered as a disqualified person. Right? So receipt of considering, receipt of consideration by fiduciary in his own account. He cannot take the contribution in his own bank account. He has to take it in the IRA account only. If they are receiving unreasonable compensation, let's say for managing my plan, I'm giving him some extra money so that he can invest it somewhere else and generate some more revenue instead of the IRA earnings also. Okay, so this is what is not allowed. This is a prohibited transaction. I cannot pay him extra amount just for manage my account in a different manner. Or any act between the plan and disqualified person means if I am going to sell or exchange or lease the property, that is not allowed. That is a prohibited transaction. I can't lend the money or extend the credit from my IRA account. It's not a simple bank account. It's your retirement account, right? If you're going to furnish a goods or services or facilities, the taxpayer and fiduciary are interrelated because of these reasons. Okay, furnishing the goods or services, then in that case it is not allowed. Let's say I am providing EA coaching, right? The fiduciary wants to also pursue EA. He is also managing my IRA account. So I am providing him free of cost the EA coaching just because he is taking care of my IRA plan account. So that thing is not allowed. That transaction is only prohibited. Okay, so what are the disqualified person? Fiduciary, any of his related. Person providing services to the plan. Okay, whoever is going to provide services to the plan or any of the related person. The employer, okay, who is maintaining the IRA account with the bank or that fiduciary. The employer, if any of his employee is covered by the plan, right? Employee organization, if any of the members are covered. Employee plus employer organization, directly, indirectly, if they are owning 50% interest on any of the above points. Okay. Clear guys? So this is how you can just remember the disqualified person definition. Wherever in question it is asked, indirectly they'll give you a case scenario. If there is a case scenario which covers any of these people, then that transaction is a disqualified because it is been taking place with a disqualified person, right? So member, family of above will also be a disqualified person, officer, director, or more than 10% shareholder and highly compensated employee, or a more than 10% partner. Please remember here the percentage ownership is 10%, 10% shareholder, 10% partner. Okay. Now tax, if you do a prohibited transaction, see if you're doing any of these three scenarios, or if it is done with any of the disqualified person, straight away you will have to pay 15% penalty, 15% tax on the transaction. If you forgot to pay that, straight away whole 100% amount involved will be liable for the tax. Okay, so see, pension annuities from a non-qualified deferred compensation plan or a non-government 457 plan are not reported on Schedule 1. Line 80, but now according to the amendments it will now be reported on Schedule 1 line 80. Any pension or annuity from a non-qualified deferred compensation plan. Deferred compensation means your compensation is deducted right now, you will receive it later on after few number of years. So that is, you're deferring your compensation. Right now you're not paying any taxes on that, you're deferring it in the upcoming years. So that deferred compensation given to a non-government employees under section 457 plan, then earlier it was not reported anywhere, but since you're deferring your compensation, now you have to report it on schedule L8T. Okay, clear guys? So next one is social security benefit. When you are going to receive a social security benefit after the age of your retirement, like after retiring, as soon as you reach the age of retirement, you will start receiving the social security benefit from the government, right? So in this particular scenario, just like in interest, certain interest income is tax exempt, certain is taxable. Dividend, certain is ordinary dividend, certain is qualified dividend. Same way for social security, whatever amount you receive, certain is tax exempt, certain is taxable. So let's understand how much is tax exempt, how much is taxable. For that, first you need to figure out what is your provisional income. Provisional income will include all your AGI. AGI means the adjusted gross income. Okay, on the first page of your 1040 you will see it, the adjusted gross income. In that, tax exempt income are not included, right? So add it back. Foreign income are not included, so add it back. See, if these things are already included, do not add it. Read the question carefully in exam. If it is already given that this is the provisional income or AGI including tax exempt and foreign income, do not add it back. Okay, else add it back. Plus 50% of social security. So take a 50% of whatever benefit you are receiving, take that. So this is your provisional income, right? Now this income needs to be compared with two limits. One limit is base amount and second limit is adjusted base amount. You have to remember this limit. There is no option in not remembering this limit. Okay, wherever it is necessary, I'll announce it to remember it. So base amount for social security benefit calculation is 32,000 in case of MFJ and 25,000 in case of others. For MFS, even you earn $0. Okay, this is your base limit, is your AGI. Okay, so even if this is your base limit. Even if you are going to have a $0 up to a certain limit, you have to make your social security benefit a taxable amount. This is not your AGI actually, this is just a base amount given by the IRS. Up to this much amount, if your provisional income is falling up to this much amount, no need to include anything into your social security benefit. Okay, as soon as your base amount, this provisional income is falling somewhere between base amount and adjusted base amount. What do you mean by adjusted base amount? Just add a certain limit. See, here it is 32,000 and 25,000. Okay, here you need to add 12,000. Here you need to add 9,000. So your adjusted base amount will be 44,000, and here it will be 34,000. So yes, you have to remember all these three limits, right? Now draw a timeline. In exam, in regular class also, we have studied each and every topic, drawing everything on the timeline. Okay, then only conceptual clarity will be done, else you will mug up the things. See, draw here the base amount, draw here the adjusted base amount like this. Okay, now see, where is your provisional income falling? If your provisional income is falling below this, nothing is included in your income. 0% is included in the gross income. Okay, if your provisional income is falling somewhere between this, 50% of social security benefit or 50% of provisional income, whichever is lower, will be considered as your taxable SSB. Okay, as soon as your base amount is going above this limit, what you have to do is straight away take your provisional income minus your adjusted base amount limit, that is 44,000. Let's say here it is 44,000, here it is 34,000. Okay, straight away take provisional income minus 44,000, whatever is the amount, multiply it by 85%, or whatever is your social security benefit, multiply by 85%. So this is your provisional income minus 44,000. Okay, this into 85% plus this up to this much also you have to apply 50%, right? So the difference amount was 12,000 in the scenario, 34 and 44. right? Here it is 12,000, yes. So on 12,000, apply 50%. Okay, 12,000 into 50% or social security benefit into 50%, whichever is lower, this you need to add it over here. So please make sure there is a difference. There is a difference between considering the social security benefit as per a slab calculation and directly applying 85 and 50. And usually in exam, they can ask for your 85% calculation. Okay, so in our regular class already we have done this calculation very well. So I hope you guys remember. And in case if you don't remember or if you're not able to find any question on this, find the GLAM book. In that social security benefit topic is there. There is one question where the age limit of the person is 65 years of age. They are earning some AGI, provisional income is going over and above the $44,000. There the whole calculation is done. Just I'll explain it in a very short manner. How you have to calculate is take your adjusted basis and okay, base amount and adjusted base amount. So difference of this is 12,000 multiply by 50% or social security benefit into 50%, whichever is lower. You will get this one amount, right? Now next is take your provisional income minus 44,000. This is your amount. Straight away multiply it by 85% or social security benefit into 85%, whichever is lower. Take this amount. Okay, total up this plus this will be your social security benefit taxable. It will included in the gross income. Okay, clear guys? So please make sure to solve at least 1 or 2 MCQ, complex MCQs on the social security benefit. It can be asked in the exam. Next one is rental income and expenses. All income which you generate by using your rental property. Okay, you are the owner of the property, but it's just a passive income. You have just invested into the property just for your investment purpose. Your main activity is not a renting business. So take all the gross income, add any prepaid rent. Please remember here, whether you are a cash basis, whether you are accrual basis, in both the cases, all advance rent will be taxable in the year in which it is received. Okay, improvement in the lien of rent means the tenant has not made any rent payment. Instead of that, the tenant has made some improvement in the property. Okay, so that fair market value of that repairs, maintenance or improvement made in the house will be considered as a rent payment, and the person who is the owner will have to include it in the income. Okay, plus any other amount received from the tenant which is in the lieu of rent will be added, minus all the rental expense. Okay, real estate taxes, mortgage, interest, all the utilities bills, everything which is been paid by the owner will be considered in the rental expense as a deduction. So this is your net rental income or expense, and this can only offset against the passive losses. Okay, let's say if there is a loss here, let's say it's a loss, it will offset first against income, passive income, and then loss. Then it will get carry forward if anything is remaining. Now please remember here one thing which is not mentioned in this scenario. Whenever you have a passive loss, first offset against if it fulfills the criteria of rental income and material participation. Okay, see this in this scenario we will see it. Yeah, this one. Let's first complete this. If it's a rental activity loss, straight away set it off against the passive income. Okay, but if you have a loss in passive activity from all the sides, you cannot set off anything. You have to ultimately carry it forward. But IRS has given an opportunity that up to 25,000 you can offset against the active income. But for offsetting the 25,000, few condition needs to be satisfied, which is if more than 50% work is involved in real property, trade or business. More than 50% work means if your participation is material participation with 750 hours plus your rental losses up to 25,000. So you can easily set off 25,000 against ordinary income, means from your wages, salaries, schedule C, any active income you can set off. Okay. Second one is modified AGI should be up to 100,000. If it is more than 100,000, this $25,000 will get phased out. Okay. So please remember, ordinary income should be, from ordinary income you can use how much? 25,000. Any remaining loss will get settle off against passive income. So here, whenever you fulfill all the conditions of material participation and active participation, first of all, if you have a passive loss, even if you have a passive income, first set off this losses up to 25,000 against active income. Okay, this is how you are reducing your income slab rates. Now, if you are going to have more losses even after 25,000, set it off against the passive income in the second step, and anything is remaining will get carried forward. Now, let's see how to calculate the phase out. If your modified AGI is more than 100,000, right, straight away take the highest value, that is 150,000. Sorry, straight away take the highest upper limit. Here, the upper limit will be 150,000. So 150,000 minus the lower limit minus the actual AGI. Our upper limit is 150,000, but our actual AGI, you have to take the difference and multiply it by 50%. Or 25,000, whichever is lower, you will get the deduction. So maximum allowable deduction will limit to this formula in case if you have your AGI more than $100,000. Okay, so coming back to the scenario over here. Yes, rental income and expense. This is the formula to find out the net rental income and expense. Now, what all things will be considered? If you have a rental vacation home, then there is one more rule, that is 15 days if you have lived in the house, your own vacation home. Okay, if you have lived in that house for less than 15 days, it will be regarded as a deemed personal property. Okay, so no rental income, if you have rented it. So if you have rented it for less than 15 days, okay, it's your own vacation home, you are renting it for less than 15 days, then no rental income will be recorded, no taxes you have to pay, no deductions, no depreciation will be allowed, and no expenses will be allowed. In short, it will not be considered as a rental income in your tax return. Only you can take a municipal tax, mortgage interest on your Schedule A of your 1040 return. It will not create any Schedule E. But on the other side, if you're going to rent it for more than 15 days, at least 15 or more than 15, then first check, are you using that property for personal use for at least 14 days or more than 10% of rented days? If these two conditions are satisfied, if yes, it will be deemed personal cum rental property, right? And all expenses will be prorated, means between the personal and the rented days, you need to allocate it between the number of days used for personal purpose, number of days used for the rented purpose. Okay, clear guys? So next one is rental expenses. Rental expenses, if it's an insurance premium paid in advance, then it is non-deductible. Insurance premium paid in advance is non-deductible. Cost of repairs is deductible. If you are going to take any improvements or any expense that increases the value of property, you need to check the de minimis safe harbor rule. What is de minimis safe harbor rule? The amount of expense which you are incurring, if it is up to 2,500, it can be easily considered as a revenue expense added in the P&L. But as soon as the amount goes more than 2,500, it should be capitalized. Okay, and if you are incurring some cost of improvement, what do you mean by improvement? If it's increased the value the life of the asset, then it's a cost of improvement. Even if it's more than 200, you can capitalize it, it's non-deductible. Okay, clear? So this one is for the rental activity loss. And next, yeah, standard mileage. In recent exams, standard mileage rates were asked, so please make this small changes. For business mileage, if you are going to use a Schedule C, for that the mileage rate has changed to 65.5 cent. Only single rate has been there. Previous year, the rates were divided into two different rates. So right now it's for business miles 65.5 cent. For medical miles, it's 22 cent. For charitable miles, okay, when you're traveling to do some charity work, 14 cent will be there. And if it's a real estate business, okay, straight away business miles, that is 65.5 cent you can use. Okay, what are these tandem miles? I hope everyone know. Instead of taking the actual deduction on your motor vehicle, you can go for the standard deduction based on the number of mileage you have traveled into the cent. Cent is means $1 is 100 cent. So it's just like a percentage you can apply straight away on your mileage. Okay, next one is business income and expenses. So this is very simple. When you have a sole proprietor business and you don't want to form a separate entity, S corp, or you don't want to do any partnership or C corp, you can straight away form it as a single business. That is Schedule C 1040 will be filed and it will be reflected on Schedule 1. What all things will be considered? Take all the gross receipts as an income minus all business related expense. Do not consider any personal expense over here. Okay, so in exam they can give you a lot of income and expense details. You just need to find out what is the profit and loss of the business. Okay, this simple questions can be asked, so be prepared. And second thing is, whenever you are filing a Schedule C, please remember, when you file a W2 wages, you are earning, you pay the payroll tax, right? Same way for Schedule C, you will be filing a SE, Schedule SE, for paying the self-employment taxes. So taxpayer will be paying the federal income tax plus taxpayer will be paying the self-employment tax. And we have seen that in the regular class, the whole calculation of the self-employment tax, the whole taxes will exactly have the same percentage of tax rate as there in the payroll taxes, 15.3%, right? And this can be offset against the ordinary income as well. So it's not like a passive activity, it will offset against passive only. Since you are involved 100% in the business, it's a Schedule C business, it will offset against the Schedule C, other Schedule C's or other ordinary incomes, that is wages, commission, okay, all other incomes it can be used to offset, right? Next is always use the accrual method for reporting the inventory. If being a Schedule C still you want to report inventory, you want to maintain the inventory in your books, you will have to use the accrual method of reporting the inventory. The whole tax return will be filed based on accrual method if you want to maintain the inventory valuation as well. Okay, now what is the business loss limitation rule? So this is important, guys. Usually people get confused between these rules. Okay, so we'll come to these rules. Let's complete this one first. Yes, business loss rules. One is business loss limitation rule. Second is NOL rule. Business loss limitation, the same thing is there in very much detail in our part 2. In part 2, whenever you have a losses in S corp, in a partnership, how much loss can be carried to the partner's return or S corp shareholders return, that have a proper segregation. First, you are going to utilize the tax basis. Second, at risk rule. Third is passive activity loss limitation rule, and the fourth is business loss limitation rule. Okay, so remaining, still there is something remaining, will be offset against the ordinary income. Now let's say you are a shareholder in a S corp, you are a partner in the partnership firm, or you are just an individual, but you are receiving a K1 from them in that the loss is mentioned. So while you're filing a 1040, can you take that losses in your tax return? The answer is yes, but in this sequence you have to take it. Okay, the sequence we have done it in the very detail. I'm not getting into the detail part. Those who have already taken the lectures, they might have seen the whole sequence we have done in the regular class. Okay, so it will be the same sequence will be used. What is NOL rule, guys? Whenever a general rule is like whenever you have a loss, it will get carried forward indefinitely. Okay, second is business loss limitation will apply, which we will learn over here in the next page. Right, business loss limitation means whenever you carry forward in that year, how much percentage you can offset your losses against your ordinary income. There are specified percentage mentioned by each and every, mentioned for each year separately. Okay, so we'll see that. See, now in NOL rule, general rule is carry forward indefinitely. But what is business loss limitation rule? You are allowed to take straight away 289,000 and for MFJ 278,000 of deduction. This is allowed. Okay, now against passive income, if losses are related to passive, okay, or against ordinary income if losses are related to active income, ordinary activity, active activity. But if the passive activity is having material participation is more than 500 hours. For Schedule C, please don't get confused between 500 hours and 750 hours. 750 hours was for Schedule E, that rental activity. This passive activity means what? You are running your business, but since last 2 years you are generating a loss out of 5 years, so this becomes your passive activity, and you are not involving yourself more than 500 hours, then it is your passive activity. So if you identify your Schedule C is running into a passive form, you can easily take this much deduction against your passive income. Okay, but if you are running active business, you are involving yourself for more than 500 hours, this much losses you can take against your active incomes, okay, your ordinary income. Anything which is remaining apart from 289,000, 578,000, please remember this limits, 289, 578,000, this much loss you can offset against either passive or either active depending on the number of hours of participation. Remaining can be carried forward indefinitely. Okay. Next is business loss limitation rule. So here a little bit glimpse of it is mentioned, but it's a very huge topic actually. So first of all, you will use the tax basis. Cash property which you actually put into the business, that is your tax basis. The initial contribution which you are going to bring into the business, that is the tax basis. Whatever is the cost you are incurring to bring into the business, that is your tax basis. So cash property you put in the business, use net book value, that is cost minus depreciation up to the date. Second is at risk. Now let's say you have taken up some loan or the mortgage to bring that property into the business. So up to the loan amount you are at risk, right? Tax basis means cost minus depreciation. At risk means if you have borrowed the money, if you have given some personal guarantee, so you are at risk for that much amount. Third one is passive activity loss limitation. Means you are not actively participating in the partnership or S-corp, so that activity will be a passive activity. So passive activity loss can offset against only passive income only. So make sure when you receive a K1, check which kind of partner you are. Main thing is if you're a general partner, you are having a active income. If you're a limited partner, that income is your passive income. Okay, and the last rule is business loss limitation rule, which we have seen that passive against passive, active against active. Here the 25,000 set off, we will use that rule, okay, if it is applicable. Now let's see how much carry back, carry forward rule is there and how much percentage you can offset. So if you have any losses which is getting carried forward since 2018, before 2018, then for those losses relating to 2018 and before 2018, okay, not 2018, before 2018, it can be carried back for 2 years. First, we are understanding the rule of carry back only. Any losses which are relating to 2018, 19 and 20, this 3 years tax return you have to check, is that loss pertaining to that particular year, then it can be carried back to 5 years. After 2020, there is no carry back allowed. Okay. Now let's check about the carry forward. In case of carry forward, if your losses are relating to 2017, 16, 15, means before 2018, you can carry forward for only 20 years. Now you will think that why we should learn something about 2018, 19 and this all years. It's not applicable for current year. The answer is no. If some losses related to 2018, still it might be getting carried forward till 2028, 2038 it will get carried forward, right? So you should be aware about it, which year the losses relating to. Now you will think in practical life how this happened. The whole form is generated, whole worksheet is generated, annual worksheet, where you will see that which loss pertains to which year. Number of years are mentioned. Okay, so don't get confused while preparing it in practical life also. Apart from that, any losses after 2018, all losses are carried forward indefinitely. Okay, clear guys? Now see, overall dollar limitation is there. Here, for 2018, there were limitations, but no need to remember it. In 2018 only it was applicable. Now in 2018, 19, 20, no dollar limitation. What do you mean by dollar limitations? Means maximum how much you can deduct. Okay, there were no dollar limitation. In 2020 also there are no, but after 2021 there were dollar limitation. We have seen in the above scenario only 289 and 578 you can deduct. Okay, in the year of loss you can you can deduct only this much amount in the year of loss, and remaining will get carry forward. Okay, that was there in 2021. Next is maximum set off. Now you are carrying the amount forward to the next years. How much you can set off? Nothing can be settled off. This here not applicable. Here the whole 100%. There is no limit. Whole 100% is applicable. Here whole 100% of the taxable income you can settle off. But after 2020, only 80% of the taxable income is allowed to set off. Okay, so don't get confused. Please go through this chart properly and understand it. Whenever the MCQ is asked, it will be very simple, just a logical MCQ. You just need to remember the limits, time limits, and the percentage you are going to set off, and what is the carry back, carry forward rule. Okay, now let's look at the additional income quickly. First additional income is refund of state and the local income taxes. Okay, this is SALT. So if you're going to receive a refund of SALT, state and local income taxes which you have already paid, now you're going to get a refund. This will be included in your income only if you have taken the itemized deduction previously. In itemized deduction, okay, since this is a revision, you might have already completed the itemized deduction topic in your regular class. So itemized deduction means what? When you're going to get a deduction for whatever taxes you paid, either at a state and local level or the general sales tax. Okay, so refund for this paid in the prior year. If amount affect the prior year income tax, means in previous year you have taken the deduction, then report the refund as additional income on schedule 1. Because you have taken a benefit, now it will be taxable when you get a refund. If the amount is not affecting the prior year, let's say previous year you took the standard deduction instead of itemized deduction, so this will be excluded from the income. Okay, next is taxpayer who itemized a deduction may claim the deduction for the state and local taxes paid, right? Next one is, here the limit is there. See, 10,000, 5,000 is the limit in the itemized deduction. So if you have taken the itemized deduction up to this much amount, whenever you receive a refund, check that if you are going to have a tax benefit in prior year, then you can take it as a taxable income in current year. Okay, if in the year the taxpayer paid the taxes, the taxpayer either didn't itemize it or elected to deduct state and local general tax instead of state and local income tax. Local income tax, local general tax, there is a two taxes. You can take a deduction only for one, not both. Okay, got it guys? Next other income is alimony. If there is a agreement or executed in 2018 or earlier, then the 2018 or earlier means what I can say is 31st December 2018 or earlier. Else you will get confused in some of the topics, some of the material it might have mentioned 2019, before 2019. Before means, can I say 2018 or earlier? Exactly in 2019 also it is not allowed, but before 2019. So can I say, that's why I have written here the words 2018 or earlier. Okay, so property settlement or payment of the court order, child support, these are not called as alimony. Apart from this, if two person are getting divorced, okay, spouse and the taxpayer are getting divorced, and if their agreement is executed, finalized in 2018 or earlier, then the person who is going to pay it, it will be called as a deduction for him. The person who is going to receive it, it will be called as an income for that person who is receiving the alimony. Okay, but those agreements which are executed after 2018, there won't be any deduction, there won't be any income. Okay, so please remember, in case of property settlement and in case of court ordered child support, they won't be considered as a alimony. Please remember this thing. Okay, they can confuse you on this topic, and we have done this topic in detail in class. Understanding the sequence of payment. If you receive a lump sum amount, first it will be applied to child support, and then you will be applying it to alimony. Okay, what are the other incomes? Bartering income, bribes and kickbacks, gambling winnings, illegal activities, cancel debt, prizes and awards. Okay, so let's understand it quickly. See, bartering income. So report the fair market value. Let's say I have bartered my laptop for providing, I purchased the laptop against I'm providing the services of coaching. Okay. So when I'm bartering something against some services, I will have to anyways include the value of service provided or value of service received in my income, right? So what I'm going to do is report the fair market value. Report the fair market value of property or any service which I am receiving in bartering as an income in the time of exchange. Okay, at the time of exchange, let's say I'm going to provide the coaching classes. Okay, so I'm coaching to one of the students and he's having a laptop business, is going to give me the laptop against that coaching fees. So whatever I am receiving, take the FMV of that, that will be my income. That will be my income from providing the services. Okay, next one is bribes and kickbacks. It is always included in other income. No one is going to mention it specifically, right, to the CPA or EA that we have taken the bribe. But in case if it is found by the IRS indirectly, they will issue you notice and you'll have to pay the interest, penalty and everything, and it should be included in your income. If you have taken the bribes or kickbacks for your business, included in Schedule C. Okay, gambling winning included as an income. Okay, if you're winning through any lottery or any gambling, just straight away included as an income. Now please remember, there can be one question on this. If you have a gambling losses, so gambling loss are allowed on Schedule A itemized deduction, but maximum only up to your gambling winnings. So if you don't have any gambling winnings, you can't take gambling losses on itemized deduction. Illegal activities, if someone is going to incur any illegal activities and through that they are earning income, then it should be included in their Schedule 1 other income, or if it's a business related illegal activity, go to Schedule C and consider it as a income and pay the self-employment tax also. Next is cancelled debt. Cancelled debt means what? Let's say I have taken a loan to purchase a laptop. Now my bank has waived off the loan. Only $5,000 or $3,000 is outstanding on that loan. Okay, or any property if I'm purchasing, there is an outstanding loan which has been waived off. So that waiver is called as an income for me. I don't have to incur any interest or principal payment on those remaining amount. So it will be included in the income. Debtor must report the cancelled or forgiven amount as an income, and the debt include any indebtedness of which the taxpayer is liable or which attaches to the property held to the taxpayer by the taxpayer. Okay, so it will be straight away included in your income. Please remember that. When it will be excluded, only if the creditors intends to cancel the debt. Okay, the person, let's say the bank is going to give me it as a gift. Okay, cancelling the debt, its intention is to cancel the debt. Without my actions, they have straight away cancelled the debt. So if the creditor means the bank who is going to cancel the debt as a gift or a biscuits, the debtor does not have to report it as an income in these three scenarios, right? And the last one is prizes and awards. If you receive any prize and awards, it will be included in your income, and if taxpayer refuse to accept the prize, it must not be included. If you're not accepting, do not include it. But yeah, if you receive some prize and awards by any means from your employer or from any XYZ third party or from your client, that needs to be included. The fair market value needs to be included in your income, right? Next is jury duty pay. It is included in the income on Schedule 1. If amount paid back to the employer, then deduct the amount as adjustment to income. Okay, jury duty means just simply think that you are doing something out of your goodness, out of your kindness. So the person, like those who are kept in some for they are kept for some of the work which is being done for or for getting rid of their deeds. Okay, some police department can ask the jailers to work. Okay, so that is a jury duty. On the jury, they are doing the duty, and in that case, if they are going to earn, it is included on the income. Okay, if amount is paid back to the employer, now let's say they are earning something, they are paying back to the employer, then it is not to be included, it will be deducted. First you need to straight away include and then take a deduction from adjustment to income. Okay, next one is rental of personal property. Personal property means your car, your movable property. Okay, when you're renting your movable property, include that rent as an income. Okay, and whatever you are going to have a business of renting, that goes to Schedule C. You're just renting a simply one car, that is not your main goal, that is not your main business, then straight away include it in other income. Else your main business is renting of different cars, then it should go to Schedule C. Next is hobby income. If a people engage in a hobby for sports or recreation, not to make a profit, their main intention is not to make profit, they are just engaging in the hobby or some sport. So hobby expenses are non-deductible, but yes, income, if you're going to earn from that sport, it will be taxable. Okay, except for some certain horse related activities. Now, if you have some horse related activities, IRS presumes this activities is carried on for profit. If it produce profit in at least 3 years out of 5 tax years, then this will not be considered as your hobby, it will be called as your business. Okay, gambling business you are going to run if you are going to have a 3 years of profit out of 5 years, right? All the hobby income will be allowed as a deduction. All the hobby expense is not allowed to take, all hobby income is allowed to be taxable on Schedule 1. Hobby expense is not allowed as a deduction. Got it, guys? Next one is, I think, only 2 topics are there in this chapter. Let's quickly complete it. Court award and damages. Due to some XYZ reason, if you are going to receive award and damages, okay, so let's say what all things are included. This will include interest on any award. Okay, let's say the court has already given the judgment that you are going to receive a $10,000 from XYZ party, and that party has delayed in paying you the amount, so you will receive a interest on that award, or any compensation for lost wages or lost profit in most of the cases. Okay, so it can happen that you're working with an employer and some previous wages are lost due to the breach of contract, and you went to the court case and you won the case, and you are going to receive the compensation for any lost wages. Or let's say a creditor-debtor relation is there, a supplier and purchaser relation is there, and one of them is going to breach some conditions due to which other has a loss of profit. For that they receive a compensation, so that is included in income. Second thing is punitive damages. On this you need to understand very well. When you have a penalty related damages, punitive damages means a court is going to announce a penalty, a punishment. It is not a matter if related to physical injury or sickness. If this punitive damages are because of physical injury or sickness or not, it does not matter. Okay, so any punitive damages which you receive, it does not matter if related to physical injury or sickness. Amount received as a settlement of pension rights if taxpayer did not contribute it to the plan. If you're not contributing, okay, and now you're straight away getting the settlement for pension rights, then it is taxable. Next is back pay. We have already seen the back pay in case of wages, but this back pay is for damage of emotional distress. Okay, so please remember, if there is a damage of emotional distress under this title of the civil rights, okay, no need to remember it, but please understand, when you receive some earnings due to this, earnings means you are receiving the awards and damage payment because of the emotional distress, the employer is going to pay to the employee. Okay, or the last one is attorney fees and cost when the underlying recovery is included in the gross income. Clear, guys? So these are the cost of awards and damages, court awards and damages. Whenever you are going to receive the court award and damages, this all things, first you need to see, I'll tell you one practical case scenario which I have done. The person has received a court damages for mental distress, okay, and physical injury also. At the workplace physical injury, for that the person has received the amount of back pay. Okay, now this was announced by the court order. You are going to compare this amount with the actual court expenses which you are incurring for the attorney. Up to the amount which you have expended, only that much is included in your income. Please remember this thing. That's it. That's just a short baseline to remember it. Okay, now see, damages for one of the following. What can be it? It can be for the patent or copyright, breach of contract, or interference with the business operations. Any of these three scenarios, and if you receive the damages which are in the form of interest, in the form of compensation of lost wages, punitive damages means punishable damages if you are going to receive from your employer or the third party. Or fourth one is if you receive some pension rights settlement when you have not done any pension contribution. And the last one is for the back pay damages for emotional distress. And you need to compare the attorney fees, only that much portion will be allowed to be included in the income. Clear, guys? Next one is unemployment benefit when you are unemployed. Please remember, in recent exam 1099 NEC was asked. So please don't get confused between unemployment benefit and NEC. Non-employee compensation means you're working on a contract basis. So that is your NEC. We have already done in the previous session. So please rewind it and do it properly. This is an IMP. Unemployment benefit is Form 1099G. Certain government payments showing the amount of unemployment compensation paid will be included. Any government payments if you're going to receive, right, unemployment benefit it is considered. So it will be included. Or let's say you receive a refund, you will receive 1099G, refund from the state or federal government. So it will be included in 1099G and you will include it in the income. Any other gain or losses will be in the form of 4797 to report the sales or exchange of business property. So when we do the property transaction chapter, at that time you will able to understand this thing very well. Okay, so whatever depreciation has been taken place in case of the business property, it will be reduced, right? You will see that whether the property is used for the business purpose for more than 50% of the time or not. Based on that, we will figure out whether it's a capital gain or capital loss, and whether it's for business property or any other property. Okay, some of the gain of 4797 are reported on Schedule D as a long term and some will be reported as a short term, while others will be reported as a ordinary. Why ordinary? Because short term capital gain are considered as a ordinary. Okay, and long term is a long term on which preferential tax rate will apply 0, 15, 20%. Okay, 15, 10, 20%. Yes. All right. So we'll keep the session till over here for this particular chapter. In next session, we are going to start with most important topic, that is income exclusions. Okay. So thank you guys. Have a good day. We'll meet in next session for income exclusions.